Welcome to the deep dive. You know, trying to invest well often feels like you're just lost in a fog, right? There's just so much noise, so many opinions flying around, and honestly, a lot of it just contradicts itself. Today, we're going to try and cut through some of that. We're looking at a specific framework designed to help filter what really matters from what doesn't. The goal, making smarter investment decisions.
Exactly. And we're diving deep into George Musea's book, The Vital Few versus the Trivial Many.
It's quite a compelling take. His whole strategy kind of hinges on this idea that success isn't about listening to everyone. It's about identifying the small, really predictive group. He calls them the vital few.
Okay, the vital few.
Yeah, and then recognizing the much larger group, the trivial many, whose actions often tell you the exact opposite of what you should be doing. They're like a contrary indicator. Interesting. So our mission today is really to unpack that. Who are these groups? Why is focusing on this vital few supposedly so important? And maybe most importantly, how can you actually use this? We'll talk about insider trading analysis and this tool Muzea calls the magic T to maybe time things better and, crucially, keep emotions in check.
Right. Because for you listening, especially if you're already trying to follow the markets, this offers a really different angle, maybe even a shortcut to spotting those aha moments in all the data.
Think of it like trying to see where the smart money is actually going versus just where the crowd happens to be running at that moment.
That's a good way to put it. Understanding that difference is key.
Okay, let's dig in. Where does this whole vital few, trivial many idea even come from? What's the foundation?
Well, the core concept isn't actually brand new. It traces back to Vilfredo Pareto. He was an Italian economist way back in the 19th century.
Oh, the Pareto principle guy.
That's the one. He noticed things like, roughly 80% of the land in Italy was owned by just 20% of the people. He even saw it in his garden, apparently. Said 80% of his peas came from just 20% of the pea pods he planted.
Right, the 80-20 rule. It pops up everywhere once you start looking for it. Like in business, 80% of your sales might come from 20% of your customers.
Or 80% of the complaints from 20% of the employees, maybe.
Yeah, maybe that too.
But it's this principle of unequal distribution. A small fraction often drives the vast majority of the results. Muzea figured, okay, this has got to apply to the stock market too. He reasoned that real, sustained investment success needs a certain kind of thinking, a certain discipline. And most people, the vast majority, his trivial many, they just don't consistently operate that way.
So the challenge becomes identifying that other group, the effective 20%, the vital few.
Exactly. Who are they?
All right, before we get to the vital few, let's nail down the trivial many. According to Muzea, who falls into this bigger group whose actions we should maybe be wary of.
Well, it's essentially the broad mass of investors, the general public. He describes them, maybe a bit bluntly, as sometimes acting like cattle.
Just following the herd, chasing whatever's popular.
Pretty much. Following the loudest trend, the hottest stock story of the moment.
Does he point fingers at any specific groups?
He does. He includes many market letter writers, the subscription newsletters, and a lot of financial experts you see quoted everywhere. Not saying they aren't smart people, but the book argues that the sheer number of factors hitting the market makes it almost impossible for anyone relying only on external info to be consistently right over the long haul. He even mentions studies suggesting, fitting the 80-20 rule again, that most market advisors don't actually make money for their clients long term.
Ouch. What about the financial media? The 247 market channels.
Yeah, them too. Look, they're businesses, right? They need eyeballs, they need clicks, so they have to fill airtime, constantly report something. And often, the analysts they feature are, by Musea's definition, part of that trivial many echo chamber. The real vital few, he argues, are usually too busy actually making money or just don't need that kind of public spotlight.
Okay, so experts, media, and then just regular folks, friends, neighbors, the general buzz.
Absolutely. Their collective mood, the general sentiment out there, becomes a huge tell, especially at market peaks and troughs. Euphoria signals a top is maybe near. Widespread fear and despair often signal a bottom. It's that collective, trivial, many behavior.
Let's look at some great stories illustrating this, like back in the early 80s oil boom.
Oh, yeah. Muzea noticed insiders, the corporate execs, were quietly selling energy stocks. Meanwhile, he's hearing about dentists selling their practices to go drill for oil in Texas.
Seriously, dentists.
That's the story. And brokers were bragging loudly about their energy stock gains. It was peak hype.
A perfect storm of the trivial many piling in just as the informed folks were getting out.
Exactly. And the source notes, the really glowing news reports about the oil boom came out just before those stocks tanked.
Wow. And that Florida real estate anecdote, too,
Yeah,
late 70s.
right. Real estate was booming. He's playing tennis. Here's this loud broker nearby just going on and on. Prices can only go up.
Hmm.
At the same time, his friend, who is a contrarian thinker, is quietly on his cell phone selling off his Florida properties.
And the punchline.
5 years later, that same friend apparently bought most of those properties back for like 50 cents on the dollar.
That's incredible. It's that stark difference in behavior, isn't it? The loud crowd versus the quiet, informed move.
Precisely. And you see it again with the tech bubble stories he tells.
Yeah.
Meeting a young guy on a golf course in March 2000, quitting his job to day trade tech stocks.
Right before the crash.
Yep. Then a month later, bumping into an engineer and her mom at a spa doing the same thing, trading tech, just total mania.
And the sad follow-up. That same young guy from the golf course, 18 months later.
Driving a taxi, wiped out, swore he'd never touch stocks again.
Man, those stories really drive home the point about the trivial many buying high and selling low, driven by emotion.
They really do. And the key insight for you listening is this. When you catch yourself thinking and acting just like that crowd, swept up in the hype, chasing the same stocks everyone's talking about, you might be acting as part of the trivial many on that specific trend. And just recognizing that is a huge first step.
Okay, so that's the trivial many. Let's flip the coin. Who are the vital few? The ones Muzea says we should pay attention to.
The number one group, according to him, are corporate insiders.
Meaning?
The officers, CEO, CFO, top execs, the directors on the board, and anyone who owns a big chunk of the company, like 10% or more.
And the logic is simple, right? They just know more.
Fundamentally, yes. They have access to information about their own company, how sales are really doing, new product pipelines, potential problems, stuff that outsiders just don't see or only see much later.
And there's actual data backing this up.
Yeah, the book cites university studies that apparently show pretty consistently that trades made by these insiders as a group tend to outperform the overall market, sometimes by a pretty wide margin.
So it's not just a theory.
Seems not. Muzea gives credit to a friend, Perry Wysong, for showing him this back in the 70s, how tracking what insiders were doing was like getting a signal directly from the vital few.
Okay, so if insiders are the vital few and the crowd is the trivial many, the core strategy becomes pretty clear, doesn't it?
It crystallizes things, basically. Follow the insiders, fade the crowd.
Meaning invest only when?
Invest only when the vital few, the insiders, are buying their own stock in a significant way, and at the same time, the trivial many, the public, the media, general sentiment are negative, maybe even selling or panicking.
That sounds difficult. Implies you might sit on the sidelines for a long time.
It absolutely does. That's maybe the toughest part. The book puts it bluntly. Only losers bet on every horse race. It is the same with stocks.
So you need patience, serious patience.
And discipline. It's a deeply contrarian way to operate. You're buying when everything looks awful, when fear is thick in the air, when sentiment is just terrible. And conversely, you might be selling or staying out when everyone else is celebrating and feeling euphoric. Insiders themselves often act like contrarians, buying low, selling high in their own stock. It makes sense for them.
Okay, let's get practical. How do you actually do this? How do you analyze insider trading data effectively? It can't just be, oh, look, the CEO bought some shares.
No, definitely not. Muzea stresses you need to filter the data. He has several key points. First, focus only on open market trades, buying or selling shares on the open market with their own money.
Not stock options being exercised or shares they get as part of their pay.
Exactly. Those aren't usually driven by the same kind of informed discretionary decision-making about the stock's value right now. Second, and this is really important, look for divergence.
Divergence, meaning?
Normal insider behavior is buying when the stock price is weak, selling when it's strong. Makes sense. Divergence is when they do the opposite, like they start buying heavily even as the stock price is rising, or they sell heavily even as the stock price is falling. That can be a powerful signal that maybe there's significant news coming, good or bad, that the market doesn't know yet.
Ah, okay. So unexpected behavior relative to the price trend. What else?
Consider who is doing the buying or selling. Operating officers, the CEO, CFO, division heads, they're usually closer to the day-to-day business than, say, an outside director who attends a few board meetings. Their trades might carry more weight.
Makes sense. And the size of the trade matters.
Absolutely. Is it just a tiny nibble, a few shares? Or are they making substantial purchases, investing large dollar amounts? And crucially, especially for depressed stocks, are they significantly increasing their ownership percentage? Like buying enough to boost their stake by 30% or more? That shows real conviction.
So you're looking for meaningful, informed actions, not just routine transactions. Where can people even find this data?
Well, the source mentions common places like Yahoo Finance. They usually have an insider transactions link for each stock. Just make sure you filter for those open market buys and sells. Or more specialized services like the Washington service exist too. And the good news is, since around 2003, the rules require insiders to report these trades much faster, usually within 2 business days. So the data is pretty timely now.
Okay, that's really useful on the insider front. Now, what about this magic tea? It sounds like Musea's system for bringing it all together and trying to time the market without getting swayed by emotion.
That's exactly what it's for. It's actually a really simple, almost low-tech visual tool he came up with. You literally just draw a big T on a piece of paper.
Okay.
On the left side of the T, you write buy. On the right side, you write stay out. Then you take his key market indicators and place each one under the column that it currently points to.
And what are those key indicators for the magic tea?
There are 5 main ones mentioned in the book. And here's the really interesting part. Most of them are based on that trivial many behavior used as reverse indicators.
Reverse indicators. How does that work?
Okay, first indicator, insiders. This one is straightforward, standard. If the vital few, the insiders, are net buyers, put a check under buy. If they're net sellers, check stay out. You follow them directly.
Simple enough. What's next?
Second, advisory sentiment. This is a reverse indicator. If surveys show market advisors are super bullish, overwhelmingly positive.
Put it under stay out.
Exactly, because that's peak trivial indicator. Many optimism. If advisors are overwhelmingly bearish, scared.
That goes under buy. Got it.
Third, mood of the media. Another reverse indicator. Financial news, relentlessly positive. Bullish experts paraded everywhere. Put it under stay out. News cycle dominated by doom and gloom. Market crash predictions. That goes under buy. And think about extreme CNBC cheerleading versus extreme pessimism.
Okay, makes sense. Fourth,
mood of friends and acquaintances. Also reverse. Are people, the general public, giddy about stocks? Everyone bragging about gains? That's a stay out signal. Conversely, are they terrified, depressed about their portfolios, convinced stocks are dead? That goes under buy. Remember that book fair story where Muzea felt like he had leprosy just mentioning stocks?
Yeah, that was peak pessimism, so that signals buy.
Right. And fifth, state of the market. Technically speaking, this is also used as a reverse indicator within the Magic T framework for timing. Market way up, looking overbought, stretched, put it under stay out. Market beaten down, oversold, clearly in a downtrend, put it under buy.
Okay, so you've got these 5 indicators, place them in either the buy or stay out column. Then what?
Then you just count them up. Whichever side has more checks or tallies determines the overall signal. If buy wins, the framework suggests it's likely a good time to look for opportunities. If stay out wins, it suggests caution, stay on the sidelines.
Does the book show this magic tea in action? Like real-world examples?
It does give a few. For instance, July 2002. He notes insiders were kind of neutral, maybe leaning slightly negative. But advisory sentiment, media mood, friends mood, and the market state technical condition were all deeply bearish or oversold. So the Magic T tally overwhelmingly pointed to buy. His firm apparently sent a memo saying market upgrade, low risk entry point. The Dow was around 7,500 then.
And it caught the bottom or close to it?
Pretty close to a major bottom, yeah. Then there was March 2003, another strong signal. Insiders were actually buying then. Sentiment was still super bearish. The market was technically extremely oversold, like most in 37 years, he claims. Media was depressing. Public mood was awful, that book fair leprosy feeling. Everything screamed buy. Conclusion, deeply oversold market, pessimism, insiders buying, low-risk entry point. Dow was still in that 7,500 area.
Wow. What about a stay-out signal?
August 2003 is a good example. By then, insiders had turned negative selling. Sentiment, media, friends were all bullish. The market looked overbought. The Magic T clearly signaled stay out. The memo advised a downgrade to neutral, more defensive posture. The Dow was way up, near 10,700.
But you mentioned the signal was early.
That's right, and this highlights the challenge. The market actually kept grinding higher for another 6 months or so after that stay-out signal. It topped out later.
So that brings up a really important point. How do you deal with that? The emotional side. Being early, feeling like you're missing out when the Magic T says stay out, but the market keeps rising.
Muzea is very direct about this in the source. It takes incredible patience and discipline. You will feel that fear of missing out sometimes. It's painful. But the whole point of the framework isn't to perfectly nail every top and bottom or catch every single wiggle. It's about trying to invest only when the odds, filtered through this vital few trivial many lens via the Magic T are heavily in your favor. It's about aiming for those low-risk entry points and, maybe more importantly, avoiding getting caught in the big drawdowns. You accept missing some potential upside to protect against major downside. The Magic T is the tool to force that objectivity when your emotions or the crowd are screaming otherwise. Okay. The book also mentions combining this with other tools like technical analysis.
Yeah, it's not necessarily meant to be used in total isolation. Well, the Magic T gives you that big picture buy or stay out signal based on those sentiment and insider extremes. Technical analysis looking at charts, price action, volume, indicators like OBV or relative strength can help you refine the timing of your actual entry after you get a Magic T buy signal. So maybe the Magic T says buy conditions are ripe, and then you might wait for a technical signal like the price breaking above a certain level or a moving average turning up to actually pull the trigger.
Exactly. Technical signals often lag the sentiment extremes or insider buying, but they can act as confirmation that the tide might actually be turning. They help fine-tune the execution potentially.
Interesting. And there was a mention of George Soros's idea of reflexivity. How does that fit in?
Right, reflexivity. The basic idea from Soros is that markets aren't just passive mechanisms reflecting underlying value. Participants' beliefs and biases actually influence the fundamentals themselves. It creates feedback loops.
Like a self-fulfilling prophecy almost.
Kind of. Bullishness leads to buying, which pushes prices up, which reinforces bullishness, potentially creating a bubble. Bearishness leads to selling, prices fall, reinforcing fear, potentially creating a panic or crash. These trends can become self-sustaining for a while.
And how does that connect back to the vital few and trivial many?
Well, it strongly supports Musea's core idea that the trivial many, the crowd, cannot be right at the major turning points. Their collective actions, driven by that reflexive feedback loop, push trends to unsustainable extremes. Reflexivity helps explain why those extremes happen and why they eventually have to reverse. The Magic T, guided by the vital few's actions against the trivial many sentiment, is essentially trying to identify when that reflexive process has gone too far and is ripe for reversal.
Okay. So the Magic T spots the condition of the extreme, and reflexivity provides kind of theoretical underpinning for why that extreme is unstable and likely to snap back.
That's a really good way to synthesize it. Both focus on watching what market participants are doing and feeling, rather than trying to predict the next GDP report or geopolitical event, which Muzea argues is nearly impossible anyway.
It definitely sounds like this whole approach requires a certain kind of mindset, a real mental toughness.
Oh, absolutely. Being a contrarian is emotionally taxing. You are deliberately going against the grain. You're buying when things look terrible and everyone else is scared out of their wits. You're potentially selling or staying out when everything looks rosy and everyone feels like a genius. That runs counter to our basic human wiring, which is often to seek safety and validation within the herd.
And that August 2003 stay-out example really highlights the pain of potentially missing gains, even if you ultimately avoided a later drop.
That's the trade-off. But the reward, or the intended reward, is investing from those points where risk seems lowest and potential reward highest based on this framework. It's like the horse racing analogy. Again, you don't bet on every race just to be in the action. You wait for the race where you think the odds are heavily skewed in your favor. That patience and discipline, guided by the Magic T, are supposed to lead to more consistent long-term success and, critically, capital preservation.
Okay, so let's just quickly reiterate the key takeaways here from this deep dive into Musea's framework. It really boils down to applying that 80-20 Pareto principle to the market, right?
Exactly. Identify the vital few, primarily corporate insiders, whose actions tend to be predictive. And then recognize the trivial source, many the crowd, the media, most experts whose collective actions, especially at emotional extremes, often act as a powerful contrary indicator.
And we talked about how to analyze that insider data, focusing on open market trades, looking for that crucial divergence, considering who's trading and how much.
Right. And then using the Magic T tool, with its emphasis on those reverse indicators tied to sentiment and media mood, to get an objective read on the market environment and hopefully time decisions better while keeping your own emotions out of it.
It's really a strategy built on observing the market's internal dynamics, isn't it? Watching participant behavior rather than guessing external events.
Precisely. It leverages the crowd's emotional extremes as actual signals while using the framework to maintain discipline.
It definitely demands patience, being willing to stand apart. But the goal is clear. Aim for those high-probability, low-risk setups and avoid getting swept away in major market downturns.
That's the essence of it.
So for you listening, maybe the question to ponder is, How are you currently filtering all the market noise? Can you start to consciously identify the trivial many signals around you, the pervasive stories, the stocks everyone suddenly loves or hates, the overall mood you pick up from news or conversations? Are you maybe following those signals without even realizing it?
Yeah. Think about Musea's classic anecdotes, the shoeshine boy, the taxi driver giving stock tips as signs of a market top. They're almost caricatures, but they represent that peak trivial fams. Many enthusiasms signaling an extreme. What's the modern equivalent for you? Is it a certain type of social media frenzy, a particular headline pattern, maybe just the tone of conversations you overhear? Are you seeing that kind of signal now? And what might it mean if you look at it through this vital few versus trivial many lens? Definitely some food for thought as you navigate the daily onslaught of market information.
A really different perspective to consider. Thanks for joining us for this deep dive.